Good afternoon. This is Rupert Thompson, Chief Investment Officer at Kingswood Group. It's 24th of August, and what I'm going to do now is just run through key developments in the equity markets last week and also our thoughts about where markets are headed over coming weeks, coming months. Well, equities last week were actually pretty dull. They edged up a bit, and really the excitement was below the surface. Below the surface, there was quite a marked divergence between, say, what technology stocks did. They were up around 2.5% or so, and the FANG stocks, the mega cap tech stocks such as Facebook, Amazon, Apple, Netflix, and Google, they were up as much as 8%. So tech stocks had a pretty good week last week. By contrast, UK stocks were actually down 1% or so. And this outperformance of tech stocks, this underperformance of UK stocks, is very much a pattern which you've seen throughout this year. And year to date, actually, tech stocks have now outperformed by around 30% or more compared to global equities more generally, whereas UK stocks have actually underperformed by around 20%. And actually this marked divergence between what's been going on in the UK and what's been going on in tech stocks isn't just a recent phenomenon, it's been going on for years. And actually we had a rather depressing milestone passed last week in the shape of the market cap of Apple shooting above $2 trillion. And the sad fact is that Apple is now worth more than the entire FTSE 100. Part of this is due to the fact that obviously the Apple share price has done exceptionally well over the last couple of decades, but it's also actually down to the fact that the UK has done pretty badly over the last 2 decades. And in fact, the market cap of the FTSE 100 is actually pretty much unchanged from where it was 20 years ago. So this underperformance of the UK, outperformance of tech, is it going to continue? Well, in terms of tech, definitely if you look at the valuations of the sort of mega cap 5, the FANGs, they are on the high side. Are they back anything to sort of the kind of levels you saw in the height of the tech boom back in 2000? The short answer is no. But definitely the big mega cap tech stocks valuations are looking on the high side. But if you look at the tech sector more generally, we do think the sort of secular forces in its favour have just been reinforced by COVID, and valuations at a more general level still look reasonably sort of warranted. So we plan to retain our tech exposure for the moment, despite the fact that you have had a particularly good run so far this year, and the fact that sort of valuations in some stocks such as Apple, where the price-earnings ratio is now sort of up 35 times, is looking somewhat expensive. Moving on to the UK, valuations aren't actually cheap. The UK is cheaper than normal. The price-earnings ratio is around 25% cheaper than the rest of the world, but we remain somewhat cautious. And the reason for this is that really you generally need a catalyst in order to trigger a big change in sentiment, rather than just sort of valuations being in your favour. And on the UK, we don't really see that happening. Having said that, the data out last week was actually surprised on the upside. Business confidence picked up further in the UK. It's now higher than in both the US and Europe. It's actually close to a 7-year high. We have emphasised in the past that these business confidence indices aren't particularly reliable at these sort of major turning points in the cycle. So I think the best way to interpret the August data is just to accept that business confidence did improve somewhat further in August. The good news, though, wasn't just in terms of business confidence. Retail sales in the UK also bounced back more than expected in July. They are now actually above where they were a year ago. And certainly all of this suggests that in the third quarter, we will see a pretty decent gain in GDP, possibly to the tune of 14% or so. But even so, this comes obviously on the back of a decline of over 20% in the second quarter. And still, even if you get a 14% rise, you're still only going to be recapturing probably no more than sort of 60% of the fall you had in the second quarter. And the fact of the matter is, we still think the pace of the recovery is going to slow further later in the year. We've got the furlough scheme coming to an end, and also you've probably got this one-off pent-up demand also sort of fading away. And on top of that, clearly you've got Brexit. We had another round of UK-EU trade talks last week. They ended on a sort of fairly sour note. There was no progress. And it looks like we are headed either towards a bare bones trade deal or no trade deal at all. And that is clearly, probably won't be a disaster, but it's certainly yet another sort of unwelcome drag on the UK economy. So that's our thought on the UK. Despite relatively cheap valuations, we remain somewhat cautious. In terms of equities more generally, as ever, it remains very dependent on what happens with COVID. Today, actually, markets were up a couple of percent or so this morning. And this is because we had some positive news. We had news of a new plasma treatment for hospitalised patients. And we also had talk of a vaccine possibly being approved in the States before the presidential election. Both undoubtedly encouraging, but neither, it has to be said, will provide a silver bullet. And on the other side, you've still got the fact that we have got these secondary spikes in infections. In the States, the news has actually improved recently, but obviously in some European countries, we've had quite a marked rise. And also in some countries such as Korea, which has been doing sort of very well. In the last sort of couple of weeks, cases have also spiked there. So COVID, I still think, remains absolutely key, and it's still sort of unclear which way it's going to break. Are we going to get a further major secondary spike in infections, or will we get a sort of effective vaccine released in short order? Anyway, where does this leave us in terms of equities? Still thinking that given valuations are pretty full at the moment, and the fact that the easiest part of the bounce back in the economies is now behind us, we think equities do remain vulnerable to a correction in the next few months. But having said that, our base case is, on a year view, on a 12-month view, that the recovery does continue. So longer term, even though equities could fall back, lose some of their recent gains, longer term, we still think equities have got rather more upside than other asset classes. Thank you.